Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald. Thank you, as always, for joining me today. You know, I laid out two very distinct scenarios in last Sunday's short. Number one, a dip into earnings if traders wanted lower prices and to get on board, or two, a run higher followed by a rug pull after otherwise great numbers that sucked in the FOMO crowd. Well, this morning, now we know it's what? It's number two. The news is already calling it a tariff tantrum, of course, but how predictable is that? It's an opportunity. The markets always do this, right? I mean, it doesn't matter if you're a trader or an investor. The markets don't move in straight lines, and they never have. They never will. You can almost set your watch by what happens. First, there's a strong run up, then there's a brief pullback for whatever reason du jour. Traders inevitably overreact, but smart investors stay the course. The noise today is just that, noise. Moreover, it proves a point that I make incessantly. You have got to be in to win if winning is actually what you want to do. Just saying. Anyway, oh yeah, before I forget, this also brings up a second point. If you're not willing to invest when the chips are down, you can't reasonably expect to be ahead when they're up. Here's my playbook today. Number one, if you're worried about tariffs, and a lot of people are, two words for you. Remember April. Enough said. The S&P 500 has returned 22.96% off April lows when everybody was running around like the sky was falling. I told you right here during the worst of it, and at a seminar in Dallas that week, and during an interview with the fabulous Charles Payne, to buy. Now, this is important because many aspiring investors want to be right, but the world's most successful investors focus on being profitable. It's a nuance, but a big one. So here's what I want you to do about it. And this is harder than it sounds. Take a look in the mirror right now and ask yourself who you really are. Then, if you don't like the answer, do something about it, like changing your habits, turning off the news, unsubscribing from the clickbait that makes you anxious. Ditch the toxic people who cause you to worry. Then, drum roll please, start investing in optimism or trading like you mean it instead of playing the Vegas tables and griping when the dealer takes away your chips. We're not here for the dental plan. Number two, paging Dr. Jerome Powell, labor has flatlined. I'm astonished by this, but not surprised. Jay Powell still thinks we got this when it comes to labor markets, and he stubbornly refuses to lower rates. Well, let's review what's actually happening here. Non-farm payrolls for July, just 76,000, with downward revisions to June, down 14,000 from 147,000, and for May, down to 19,000 from 144,000. Table A, meanwhile, showed employed persons in July at minus 260,000, but employed persons at plus 221,000. That's like taking blood out of your left arm and putting it in your right. July unemployment increased for, well, every group measured. Now, my POV is very simple. I think Jay Powell needs to be benched, and the sooner the better. I mean, I really feel for the guy. He is not stupid, but the Fed's models are badly broken, and that's the problem here. I don't know if this is worse or simply bad, but he's got scores of super smart people in the building who have very little, if any, experience with real money and real businesses, so they can't make proactive decisions if they had to. It's not like this is new, right? I mean, I've been harshly critical of the Fed for years. Others, a lot smarter than me, have said the same thing, or similar things anyway. Heck, even members of Powell's own team, like Fed Governor Christopher Waller, among others, have repeatedly counseled Powell that the labor markets are not as strong as they appear and encouraged Powell to do what he needs to do. Cut the dang rates, Jay Powell. Moral of the story? Trust the revisionist data history, not another dot plot, and sure as heck not another Fed presser. Number three, buy the dip or something else. All right, sports fans. Millions of investors are caught like deer in the headlights this morning after a rock-solid week of great earnings. Now, is this the start of a larger pullback into fall or a short-term headline-driven drop? And should you buy or sell? That's the question on a lot of people's minds right now. Like many things, it depends on your personal risk tolerance, objectives, and circumstances, which, of course, I don't know. Personally, I'm staying in the game, and I'm going shopping today, particularly if the red deepens. And just for kicks and to capitalize on any good news over the weekend, if I can, like, trade deals, I may buy some calls. I bet that prices rise on the S&P 500 and the NASDAQ. How about you? Keith's investing tip: in situations like this, the markets are the only store on earth where people fear a sale. Think about that one for a moment. And number 4, I've been waiting a long time for this, but anybody who's doubting Apple's AI ambitions had better pay attention. I have heard no end of people lambasting Apple for the past few years when it comes to AI, iPhone sales, and all the other reasons it's falling behind. And even me too, for insisting that Apple's on track. Good thing I've got a thick skin. It's all water under the bridge. CEO Tim Cook just laid out the biggest, greatest, most clearly defined roadmap I have ever seen, saying point blank that Apple views, quote, AI as one of the most profound technologies of our time, end quote. Now, what he's doing is called visionary foreshadowing, and it is a favorite Apple pastime for those who know how to read the tea leaves. Now, Steve Jobs, his predecessor, was an absolute master at this. And let me give you a couple examples. Jobs said the phone is the killer app in 2005, 2 years before he dropped the iPhone in 2007. Jobs said the most compelling reason for most people to buy a computer for the home will be to link it into a nationwide communications network, end quote. That was Jobs in 1983, a full year before the Mac's famous 1984 launch. Jobs said, quote, 1,000 songs in your pocket in 2003 during a Rolling Stones interview, during which he acknowledged building iTunes, which launched in 2001 and was used to prep the ecosystem. Jobs said, I don't want to have to use a keyboard. I want to talk to this computer device, etc., as if it were a person. He said that in 2010 after acquiring Siri in reference to speech-driven devices. Now, again, I get it if you want to doubt Apple. I get it if you got the shiny new toy syndrome. I get it if you don't believe what's happening. But Apple's at its most dangerous when everybody has written it off. Case in point, Apple has returned roughly 655% over the past decade. And get this, 15,916% over the past 20 years. Well, the S&P 500 has turned in 197% and 400% respectively. 407% actually, if my memory's right. Anyway, my point is this. You can doubt Apple if you want. I'm not, because I think it'd be a very foolish, frankly, stupid mistake to make at this point in history. Now, here's an investing tip to think about. Buying ETFs is great if that works for you, but buying individual stocks like Apple can be a very different ballgame when you know how to play. And finally, number 5 today, it is Issue Friday, but with a twist. If you're an OBAer, I want you to please keep an eye on your email. The mini August issue of One Bar Ahead comes out in a few hours with a brief look at how stocks with higher AI materiality are pulling away from those that don't have that, and a deeper dive into the math driving Tesla's $20 trillion trajectory. A lot of you have asked about that, so happy to oblige, and I'm going to lay out how I got there. I think you're going to be surprised by what you see. Anyway, there's also a brief portfolio review covering 5 of the biggies, OBA model recommendations, that is, making headlines, and my thinking on what we want to do next. And it's a mini issue for 2 reasons. A, because we're in the thick of earnings season. There's no sense in burning the midnight oil if we don't have to as earnings roll out and change everything we would have written anyway. And B, because we need to put the finishing touches on a new video masterclass about how to read short-term market squiggles more effectively. Plus, not for nothing, having a little extra time allows us to begin laying the groundwork for 2026. I mean, wow, I know, right? 2026, whew. Anyway, it's also perhaps time to get a precious few minutes with our families as summer begins to wane. I previously talked about this, but it's an annual tradition now, and I especially like that part because, you know what, there's more to life than money, and families are super important, including my own. So, hoo-yah! By the way, if you're not a member of OBA and you'd like to be a member of the OBA family, you can learn more about that by clicking on the link elsewhere in the written version of this, or just simply visit my website. People tell me that One Bar Ahead has changed their lives in ways they couldn't possibly imagine, and you know what? That's as humbling as heck. Today's bottom line, everything starts with a single decision: to make today better than yesterday. So, my question to you is this: what are you waiting for? You got this, I promise. As always, let's make it a great day and, of course, finish the week strong. See you Monday. Meanwhile, go have some fun, pursue your passions, hug your family, help somebody in need. It's going to be a great weekend, and let's make it that way. See you Monday.